Okie doke. Where are those sheets at? Where's the other sheets? The fair tax sheets. The one page. Got those. Why did those not get passed around? Oh, you got them. Or did they get passed around? Oh, they got stalled out. Who stalled them out? Who's the staller? Hunter? Not you guys pass them up that way. Should be plenty. Okay, so this is related to your project that's due. So you got kind of a review of what I call a subtopic. And so we'll talk about this. We're going to spend really the whole hour talking about it. So let's get started. This is all within chapter 13, dealing with fiscal policy. And what I want to start off with is walking you through the effects of an income tax on society as far as the economics behind it. This is our labor supply, labor demand curve, our labor market that we dealt with back in chapter 6. So we've got a labor demand curve, labor supply curve. The intersection of the two generates a wage, and there's a certain number of hours being worked. And so the next thing I want to look at is the effects of a tax. And this should look familiar to those of you at micro, that a tax ultimately ends up getting shared by the employer and the employee. So even if we tax the employer and we have an employer tax, or if we have a employee tax, the economics behind that ends up being that they both share it to some degree. And so we could think about the supply of labor. If you're taxing, remember the employee is the labor supply curve, right? They're the ones supplying labor. The businesses are wanting to buy labor. So if we say we're going to tax employees a certain amount of income, then that reduces the supply of labor, tends to drive up the wage, but that's not the wage that the employer has to get. I think this thing's not going to work for me. Oh, like all of those have kind of died. The boss pays $35, but of course you only get the after-tax amount, right? Because that's the whole idea of the tax, that the government's collecting money for their spending that we learned about last time. And so it creates what economists call a tax wedge. It drives the difference between what the boss pays and what the employee gets. And the impact that economists are a lot of times concerned with is the quantity effect, right? I've talked about bucket levels the whole time. We reduce the amount of labor hours being worked by imposing the tax. Creates the tax wedge, and we have what economists call a deadweight loss from that tax. So that is the effect of an income tax. This shaded area ends up being the amount of government revenue. So our big T that we have on our equation of taxes minus government spending, that is the income tax collected. There's 200 hours being worked, 200 billion hours being worked, and we're collecting an average of $15 per hour, and so that gives us the income tax that the government's collecting. All right. On the capital market, remember the loanable funds market, we've also got the supply of loanable funds, primarily made up by households, the demand for loanable funds, businesses wanting to borrow to increase the amount of capital that they have in the form of machineries and computers and buildings. And if we impose a tax on the income generated from savers, right? So if you earn 5% interest on your money, then the government wants a cut of that because that is part of your income. So the effect of an income tax in the savings market is similar to what we saw in the labor market. There's a chunk that's collected so that the person who is saving their money is not effectively getting 4%, but they're getting something less because they're paying a fraction of that to the government in the form of taxes via the income tax. From our bucket theory, again, the thing that economists focus on maybe more so than the average Joe just cares about what the tax rate is, right? If they're really thinking about where they should do or what they should do with their money, then they're thinking about that. But economists are looking at the overall amount of capital that's being invested in society. And this is the effect. It's going to be a lowering of the capital bucket. All right, questions or comments on tax setup so far? This is on the income side. All right. In reality, we've got a couple different taxes in the United States. We have a tax at the cash register called the consumption tax, or you guys would know it as the sales tax, right? You go to the cash register, you pay some money. Here in Kansas, you're looking at about 9% of the cash register of all the dollars that you buy, on top of the income taxes that you pay. So the government's got a grab on both of those flows in the economy, from the consumption side as well as in the resource market on the income side. And this was some kind of a seminal paper by Prescott that analyzed what he called the tax wedge, the overall tax in the United States versus other places. And you can see relative to these two that taxes are kind of lower relative to the United Kingdom and France. So he estimated that American consumers pay about 13% in consumption tax because some taxes are buried that you don't see them, like gasoline. You might pay 9% at the cash register, but there was some other taxes that were embodied in the price. And so it's actually a little bit higher, and the same thing with income taxes are not always just right in front of your face. So an effective marginal tax rate on the next dollar earned of 45% is what Prescott estimated back in this time frame. All right, so where did T&G go? We did this last time. So this was 2011, which I think was the data I showed you last time. So kind of a recap here. We've got taxes coming in the form of personal income taxes. Social Security, again, is not a big retirement fund. It's really just a tax and transfer program. Corporate income taxes, and then these other miscellaneous, gives us $2.8 trillion worth of tax receipts. And then where's the money going? Primarily to transfer payments. So retirees get that Social Security money. They're one of the largest transfers being made. And then we've got unemployment insurance, welfare programs, other transfer payments going on. Weapons of mass destruction, toilet paper for the White House, all of that, $1.1 trillion. Debt interest, we add them all up, it's $4 trillion. We got a $1.3 trillion deficit 1 year, right? Adding to the national debt. All right, a little recap from yesterday. So this was a couple of years ago, which is kind of amazing. We had total federal debt of $14 trillion. It is at about $16 trillion now because we've had a couple $1 trillion deficits in the meantime since I did this. This was as of July 31st, 2011. So it's getting up there pretty high. And that was the deficit we just looked at. And then we talked last time about the debt. Who's got the debt, right? Debt held by the public, because there's intragovernmental debt of $4 trillion. We've got in the hands of the public at 9.7. And then we've got foreigners here holding 4.4 trillion. Again, that's up to about 6 trillion now. So a significant amount of money held by foreigners. And should we care, should we not? China's one of the main holders. 26% of that debt is the Chinese. Japan's right in the loop there, United Kingdom, and then we're kind of sprinkled all around the world. Everybody wants a piece of the United States. It's good money. We've never defaulted. And so that's the shares of U.S. Treasury securities, which is the primary funding source of how we run a $1.3 trillion deficit. We give out these IOUs called U.S. Treasury securities. All right, questions on that? Just trying to give you a little bit of flyby. Some of this we've talked about. Matter of fact, I'll just skip this one. This is just percentages on that. All right, so there is the national debt after eliminating the intragovernmental loans. So that's a lot of zeros. That's it in all of its glory. You know, we tend to truncate it by putting, oh, it's only 9.7 trillion. Let's see how that compares with our income. My main question is, does it matter that it's big? Are we doomed? I mean, should we just pack our bags and be done with life? You know, is this the end of the world or not? So what I like to do is compare that to our income. So this represents the income of the United States at about 14.5 trillion. Again, this data is a little bit old, but around $15 trillion. Our deficit, as ugly as it is 1.3 trillion, kind of looks like that. What if we start to cross off some zeros to bring this down to earth? Who the heck knows what $1 trillion is? And we think of a different story. This is a story about a young couple that graduated from Ottawa University, and they are 4 years into their marriage, and they have a combined household income of $145,000. Is that couple doing all right at this point in life? Do you guys hope that you're making a combined income with your significant other of $145,000?
Pretty good.
Now, I haven't told the whole story yet. That young couple went out and borrowed some money. Dun, dun, dun. I told you that's not a good idea.
Never.
But they bought a house and took on a debt of $97,000. Is that couple really messed up from a personal finance standpoint? I mean, are they just doomed? $145,000 per year is their income, and they have $97,000 worth of debt. Are there a lot of Americans in a worse position than that?
Yeah.
Is there a lot of Americans in a worse position than that?
Yes.
Yes, that's not too bad of a position to be in,
We
right?
ramen for a year. And
Now, even though that couple is okay, they might have some behavior problems that they need to work on, because this year they are running up the Visa card $13,000, or they took on a car loan debt of $13,000. So this year that number is going to change from $97,000 to $110,000. Are they wiped out? Are they bankrupt? Should they just call their attorney and say, done, throw in the chips? No. All right, so my point with all this is that at the current levels, the United States is not doomed. So I don't think the size of the debt matters so much, and maybe not even the volume of the deficit in a given year. When we start to bring the numbers down to earth, the story is a little bit easier to understand, at least. So I say, does size matter? No. I don't think the size matters in this case. Maybe size matters for other things in life. But in this particular case, I don't think the size of the deficit in a given year, nor the size of the debt currently, matters. But G and T do. What are we spending G on? How are we collecting T? That type of stuff matters a whole bunch, right? So we got to dig in a little bit deeper. And I don't think it's good if we say, is that a good thing forever? That the couple keeps running the $13,000 this year, next year, next year, next year. Is that a sustainable long-run position? No, right? So that's the bad part of it. That stuff's not good. So yes, we can ride it out in a given year, but we've got a behavior problem in the United States. We've really got a behavior problem, is that we keep going to the borrowing, right? And we've been doing it consistently for 30 years, and that's really the problem, as much as where the money is spent is as well. All right. So putting it back into our picture that we've been working with the whole semester. So we have this output market, right? The goods market, and we've got the resource market. Currently, the tax stream that's coming off, according to Prescott's data, was 13%. We know it very well to be 9%. Again, that's with some figuring some other things out at the cash register. And then we've got a 32% hit at the margin on money on your paychecks coming this way. Right? So we've got this income tax and our consumption tax. And so the question is, do we have to have both? So let's think about this, maybe just changing some numbers up as a scenario. Let's say we got 9% at the cash register like we do in Kansas, and 20% is our assumed tax rate. So right now we have $100,000 of income, 20% tax rate. I have $80,000 to spend, right, after tax income. I run to the register though, I have to pay 9% to the state government and local, and so I really have consumption of real goods and services equal to $73,000 out of my $100,000 of income. You with me on that? It's just kind of a quick breakdown of how does this thing shake out in terms of consumption, our big C in our C plus I plus G plus X. What if we collected taxes a little differently and we did 0 here and we loaded it all up on consumption? What if we changed the rates around to look like that? I have $100,000 worth of income. I don't pay any income tax. My net income is equal to my gross income because I have no income tax. I pay 26% at the register, and I have $73,000 worth of consumption. Do I, as an individual in the United States of America, care which one it is for that level of income?
It doesn't change for you.
It doesn't change in terms of consumption for that particular part. Do I, as a politician, care because I might be getting caught on G, on T, or something isn't quite right? Or for them, would that be an okay thing too? In other words, do they really care where the T comes from, or do they just count the cash register of how much T I got at the end of the day?
I mean, I feel like consumption's more volatile than income is, in a sense.
Okay, I'll get back to some changes that could occur later. But from this standpoint, we've created what we call a revenue neutral policy change. In terms of the amount of tax that's in the cash register at the end of the day, we have the same amount. Right? So from a political standpoint, whether you're Democrat or Republican or independent or whatever, it's kind of not the point here. The point is, can we structure the tax system in such a way that we get the same amount, just through a different means? And the answer is yes. So we have a revenue neutral policy of collecting the same tax, in theory. All right. So what is the effect? This is getting into a little bit more of the dynamic. What is the effect of the change in 0% income tax on capital and labor? I wanted to point out that effect over there because as soon as we make the income tax disappear, there's no more wedge. And so here's where we were today. Now we move to the right. The bucket starts to get higher. When the bucket gets higher, what did we learn about economic growth? Does it tend to get higher or lower? Higher. An increase in capital accumulation, right? What about in the labor market? We get rid of the income tax. People work more hours. The labor bucket starts to fill up, right? So we got more people working. We've got even the pay adjusting down, but we've got more people, remember, adjusting down for the employer. For the employee, it's going up from 20 to 30. For the employer, it's coming down from 35 to 30. And we have more people working. So, what is the fair tax? What are some elements of a tax that we need to keep in mind if we're trying to change the tax system around? Apparently, we believe that the relatively more well-off should pay proportionately more than the relatively not so well-off, right? So that's called a progressive tax system. The higher income people pay proportionately more than lower income people. So if you make $100,000 on average, you might be hit with a 20% rate, whereas if you're only making $30,000, you might be just a 3% rate, right? So it's not like we're all paying 15% or 30%. That is called a progressive tax. And I think that is something that if you want this a policy change to go anywhere, it needs to be progressive. All right. I would argue that transparency is important. The current system, would you say that it's transparent, easy to see and understand? Does the general public understand the current tax code? What do you think? No. Nope. In fact, a lot of the people that prepare taxes really are not experts on the tax code. Because I've worked with some pretty high-level CPAs and high-level tax accountants, tax attorneys. Those people know it pretty darn well. But they still have to reference back to books because it's very complicated. But they at least know where to look, right? And they could kind of give you a snapshot of it. So to the general public, I'd say it's very opaque. I mean, we really don't know what it is. We just kind of give our stuff to our accountant or put our numbers into QuickBooks, and the computer, their TurboTax, and the TurboTax tells us that you owe this amount, and whew, glad I got that one done, right? So we can create computer programs to figure it out for us, but it's very complex. All right, so can we possibly come up with a tax that keeps that in line? So this brings us to our topic here of the fair tax, of what your project's about. So on your sheets here, this is a revised tax plan that basically says, let's throw away the income tax and completely change to a consumption tax. 23% is what the economists have estimated would be enough. 23%. If we collect 23% at the cash register, then we will have enough funds to match the tax revenues that are currently being collected by the combination of things. 23%. All right. Now, if the tax rate at the cash register, and there's a bit of a shock factor here, right? And it's like, oh my gosh, are you kidding me? So if I go buy $100 worth of stuff at Walmart, they're going to ask me for $123? Right? Wow.
Pretty big difference.
That is a big difference. What might it cause you to do?
It might make you
buy less. Yeah. And now taxes on savings are what? How much are taxes on savings income? 0. What might you be inclined to do?
Save money.
And you might be inclined to save. Now you're starting to see the transformation that could start to go on by incentivizing people to save their money as opposed to consuming their money. All right, so that's one little piece of the puzzle of changing it. But the bigger piece is that's not fair. If we believe in a progressive tax, then we're going to have poor people coming to the cash register and paying 23%, and we're going to have a multimillionaire coming to the cash register and paying 23%. So how do we fix that? And that's through this prebate idea. We're going to cut a check to every single person with a Social Security number. Every single person that is a U.S. citizen is going to get an advance on the taxes that they're going to be confronted with at the cash register. So on the first of the month, you're going to get a check. So if you are a family of a couple and 2 children, we're going to have an annual consumption allowance of $30,000, so that every year you're getting the $6,700. This is the allowance that we're figuring, which is based on the poverty line. So we want everybody to be able to gather or have enough money to pay the taxes at the poverty level of taxes. And that's just the minimum threshold. So they're going to get a check in the mailbox every month, and it probably wouldn't be in the mailbox, it'd probably be a card of some sort, right? And $564 a month. If you're single, you're going to get a check for $209 every month from the government. Whether you're Bill Gates or whether you're the least of the least, everybody's going to get $209. Now, of course, Bill Gates has the opportunity to flip that thing over, endorse it over to somebody, and hand it off, right? But the system would be that everybody gets that level prepaid. All right, well, why? Well, this is what that does. If you earn $30,000, what is your effective tax rate? Taking the prebate into account. If you earn and spend $30,000, what is your effective tax? 0. So that's what these numbers are. So if you earn $30,000, which again is, you'd want to earn more, but that's the poverty level of income. If you earn $30,000, because the government's cutting you that check, they've effectively prepaid your tax that you're going to have at the cash register. So that effectively, you have no tax whatsoever on your income, up to $30,000. Now, if you earn less, you actually get that money back in your pocket. So if you had $14,000 worth of income, the tax rate's actually negative. So this is kind of a negative income tax in a sense, even though there's no income tax, so we're not really calling that. But you're actually getting funds in excess of the amount you're spending. As you start to make more money, the tax register still rings up 23% every single time. So as you spend $58,000 worth of income, you're effectively paying an 11.5% rate. At $117,000, you're at 17.2% is your effective rate at the register. And right in this area is most of the general public, right? If we look at the income of the average American or the median American, you're going to be right in this sweet spot here, somewhere in here, which is probably significantly less overall than what you were paying currently. Because the average amount is about 15%, plus you've got payroll tax that gets kind of buried into the system to the tune of 7.65%. So you're already paying about 22 under the current system off of your income if you're in this range. Okay, let me pause there. I know I wanted to kind of make it through. Maybe you guys have 100 different questions floating through your mind, but I wanted to at least get to this part. And let me open the floor a bit for some questions. Yes?
So the government basically is not receiving any tea at this point.
They are
as you're going up. So like at 29, they're basically paying them not. They're giving money, giving it back.
That's right.
So
Yep.
how are they going to accumulate money enough to
So, good question. So Sawyer's question was, at this point, there's no tea coming in, so because we've just been cutting checks out, right? So the 23% level takes all of that into account, the checks that are going out versus the amount coming in. So it's kind of a net number. So they've taken that into account. As we go through time, there's people. So, and I don't know. Are you also thinking about this at like the beginning of the year? It's kind of negative, and then I'm not sure.
Well, I understand. Like if we started this today, the government would obviously accumulate debt from this year because as the change comes. But I'm talking about. It just seems like as you keep going and the government's giving out these rebate checks, their T is going to go significantly down. It's going to take a really long time for it to get back to where it was.
Yeah, I guess it won't. So there'll be enough spending going on because there's enough people spending initially, and that effect would be just washed out in the large scheme of things. And the 23% takes that into account when it's coming in.
Right, but that just seems like I feel like for it to be able to get up back to 20, the 22%, for it to come back in to where we are now, I feel like that would take a longer time than expected.
Right. I see what you're saying, but that's been taken into account by the estimates. And again, I haven't dug into details of exactly the 23%, but I have read enough on their program that has been taken into account, the amount of prebates that are in there. And remember, we're not necessarily trying to eliminate the deficit. We're just trying to collect enough money that's the same as the amount we're collecting now. Because in order to eliminate the deficit, you might have to decrease G. We're going to leave that to the politicians. Right? So the allocation of G, do you want to buy more weapons of mass destruction or do you want to spend it on education? I'm not talking about that. That can all be the same. You guys can have your fights on Capitol Hill and all that. All we're talking about is how do we collect T? And let's do this method that's going to collect the same amount of T as the existing system. And then hopefully we'll recoup some benefits as well.
What exactly is meant when we say annual consumption allowance? What do we mean by that?
So we're going to give enough money to pay the taxes at the poverty level of income. So that family of 4, this is the poverty level it was in 2011, was $30,000. If they get confronted with the tax, it's 23% of that number, right? So what do we got here? 10%, 3, $7,000, right? So they would have $7,000. If they spend every dime of their income, they would have $7,000 of money at the cash register. But we're going to give that to them ahead of time so that their effective rate is 0. So that's the consumption allowance. We're going to allow consumption at a minimum level to not have any tax whatsoever.
Doesn't the numbers we're running just essentially calculate how much effective tax we have under the assumption that we're going to spend everything when we already have shown that we're actually likely to do the opposite?
Yeah, no, that's taken into account too. Good question. Yes. So that's part of what they had to estimate, was that we have these different effects of now people might be saving more, which we hope they do, because that's going to accumulate the capital bucket and change things that way. And so from a grand scheme of things, we should see a shift away from C plus I plus G plus X, a few dollars coming away from C and back into I, into investment. And that gives us long-term prosperity, right? It's just all about saving your money and having it last into things. Rather than putting your money into Twinkies and beer, let's put it into computers and machines and buildings, right? So kind of a reallocation of that.
Well, and with that, like, if you're getting that rebate and you're not spending all of it, you're therefore getting a lower tax rate overall because you're actually spending
That's right.
less.
That's right. Yeah. So if you face a higher income tax currently, then you can still be better off from that. And try to imagine working 10 hours of work and making $10 an hour, and your employer cuts you a check. How much is it for? $100. Imagine that you put in 10 hours and you work $10 an hour and your employer cuts you a check for $100. We've eliminated all of that other stuff, withholdings, taxes, Social Security, Medicare, Medicaid. We're collecting all of those taxes through this mechanism, through consumption tax.
Taxing, like, businesses?
What's that?
Are we still taxing the businesses?
No, so on the savings side, business-to-business transactions of buying capital machinery and stuff like that don't have a sales tax. So it's sales tax on final goods and services, just like it is now.
Yeah.
So sales tax on final goods and services.
Well, like, I mean, is the government going to tax, like, businesses in general? Like the corporate tax? Yeah, like corporate tax.
That would wipe out the corporate tax too. Yep, wipe out all income taxes. Basically, it would actually close down the IRS. There would be no function for the Internal Revenue Service, other than compliance by businesses to watch that they're rebating the right amount from the sales tax. So there'd be some monitoring
Aren't we
costs.
just transferring it from income tax to this whole rebate system where you still have to fill out paperwork in order to qualify? You have to show what your income is, how many people live in your household.
Oh, Good question.
Type of information.
You don't need the income because it's independent of income. But it is, you do have to be a human being with a heartbeat and a social security number. And once you've established that, you get your check. So the prebate is determined by you being a human being and being an American citizen, which none of you have quite picked up on me pounding the social security number, American. It brings up another issue that is sometimes contention in the United States. Immigration, illegal immigration,
Specifically.
right? So now people who are illegal here start contributing, if they're not already. By the way, a lot of illegal immigrants do pay, they register and pay taxes on their own, but many of them don't. And now, if they go buy toilet paper at Walmart, they pay the 23%. Everybody pays 23%.
So they don't get the tax benefit.
They don't get the prebate, that's right. So they actually pay a full freight of 23%, even if they're low income or high income, because this is for US citizens.
I guess another thing that I find interesting is we're claiming that we're trying to offset and make things fair based on consumer behavior, but I feel like we're assuming a lot about one's consumer behavior based purely on family size.
I think the thought there is that each American should get that basic amount of coverage, right? So that's maybe a value judgment, but that's where that's coming from. A minimum level of minimum level. That's not a minimum. That's maybe the wrong way to word it. By the way, this doesn't necessarily eliminate welfare programs, right? Because $30,000 may not be enough to help that family get off their feet and blah 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 blah. That's all on the G side, though. We're not messing with G. This is purely on the taxes that they pay on their income. Chris?
I'm also curious how that would affect the choices of family of how many kids they would have in the long run. But also, it's not quite related, but
Let me catch you on that one first.
Okay.
So, does it give an incentive for you to crank out kids?
I mean, you have to
No,
spend
because
more to
it's
raise
not
kids.
At a constant rate.
Yeah, and kids are expensive, right? So
Kids are expensive.
if you think that the prebate amount, the little extra bump that you're getting of $200 a month, is enough to cover all of the expenses with the kid, then you're not
No.
you don't
Well,
quite
that's
have.
the same kind of argument though that's thrown around about welfare moms that they don't want to work and so they just have another child because they get another welfare check.
Right.
So it's the same kind of stereotype that's applied to people with lower incomes.
Right. And it's not, we're not even kind of going there with this. So we got to kind of keep our eye on the ball that we're just collecting taxes differently. Low income people pay, if you're at the poverty level, the way this system's designed is you pay zero tax. Period. You pay zero tax on your consumption if you're at the poverty level or lower. And actually, if you're at a lower level, then you're getting a little extra benefit. But that's not the intent of it. But the intent of it is to cover an absolute minimum level of consumption to where you pay zero tax.
So I'm confused. I thought you said it didn't go by income. By simply
The poverty level of consumption is determined by what does it cost to go to the store and buy some stuff. So that's where the $29,420 comes in. And so yeah, we're kind of hypothetically saying if you earn $30,000, currently you're deemed to be at the poverty level of income, and you're probably not doing too much saving, you're spending it all, and you're paying 9% at the register, and we might be making up the difference with other programs in place to supplement that. Again, we're not going to the programs thing. G can stay right where it is. We can have all the hotly debated stuff. We're just thinking about the T. Sorry.
Doesn't this create though a huge gap between the rich and the poor?
How?
Because the poor, okay, well, assuming stereotypes about the rich save well.
Okay.
Right? So they have a big, enough income to really support themselves highly. The poor, on the other hand, assuming they don't save very well, are getting a check and being like, wow, this is a lot more than I usually get, go out and spend it. I feel like they just kind of separate the rich and the poor in a huge gap.
Yeah, I think that's the one thing with this system that I've wondered and haven't been able to work exactly out how that shakes out. But if you're proportionately saving a bunch more, You could get into arguments of, well, what are they doing with their money? Well, they're saving it. Well, an increase in savings leads to economic growth, right? Expansion, the capital bucket grows, and we all have more of a pie. Does that cause more inequality in income? Maybe. Do we care? Maybe not. I don't know all the answers. I'm just throwing out some of the issues with inequality. Like, does it matter if we're all going up in income, even if the gap is getting wider, but the poor are getting richer and the richer are getting richer, but the gap happens to be growing? Is that a big deal? That's a different topic to explore, but an important one. And I'm not sure exactly whether this contributes to income inequality or not, and then there's different camps on, does that matter? Is that really focusing on what the issue is anyway, or is the issue focusing in on the least of the least, right? Whether the gap's there or not, let's focus in, some people would argue, let's focus it in on the most needy.
Though, the poverty, at that case, as people poor start getting richer, and richer start getting exponentially richer compared to that, when the poverty lines start to shift as we start to grow?
Not unless there's like some inflation or whatever. So the poverty line is it gets down to the real quantity of goods that you can consume to be alive, right? Housing, shelter, the basic needs of food.
Yeah.
That's how that's determined. It's not determined by what you're hinting at is income inequality is determined by relativeness, because we just take the lowest 20%. We break all of the income, we stratify it into 5 quintiles. The lowest 20%,
right.
the next 20, the next 20, the next 20. And so then by definition, whether we're rich or poor, there's always somebody that's in the lowest
Right.
20%.
But
that's not what's going on here.
But as we start moving up, though, prices, are going to probably start moving up. Like, everything is going to start shifting upward, I feel like.
No, not necessarily, because this is not necessarily inflationary. If I go back to supply and demand, and I'm so glad that you're forcing me to go back into supply and demand. If I go, let me just go like this. Let me just skip the short run aggregate supply curve. Shift to the right or shift to the left if the L bucket and the K bucket increase. Does this shift to the right or to the left? To the right, right? An increase in capital, increase in labor. Does that put upward pressure on inflation or downward pressure? Downward pressure. So this isn't inflationary. What was inflationary is when there's spending, an increase in G, where there's not anything being supported, right? So that kind of the fake spending, if you're just taking a bucket of water out of one end of the pool and throwing it to the other, that is inflationary. But here what we're doing is we're uncovering real nuggets in the economy of economic growth, kind of those underlying fundamentals. So let me pause there for a second. I got a couple more things I want to go, and we'll keep talking. You might have just found a subtopic for your paper. Your inequality issue. See what you can dig up on that. So on the website, which I need to get to here pretty soon. I still got a couple minutes. Let me burn through a couple of these hot topics here. You guys have copies of this whole PowerPoint, by the way. So it's in your inbox. I emailed it to everybody. But check this list out. There's so many fun things that we haven't even talked about. 6 billion hours is what's estimated is what's freed up by not having to fill out income tax forms.
Oh, wow.
Attorneys, accountants, other personal income tax. 6 billion hours.
No more W-4s.
6 billion hours. Just from the tax part alone, eliminating the income tax. That excites me. $265 billion are spent on income tax preparation. How many people can we pull out of poverty by devoting $265 billion towards something else, right? Think about the redirecting of funds that are potential here and still collect the same amount of T. That's the exciting part. We're just changing the system and freeing up real resources potentially. Small business. I've had lots of small businesses. That sucks. It's tough. It keeps people from opening up their own small business because of the burden that's placed on having to run payroll taxes and everything else. Now, I want a new person to work for me. They put in 10 hours, I pull out my checkbook, I cut them a check for $100, I hand it to them, done.
Makes running a business really easy.
It makes running a business way easier, and I think it would help encourage small business in the United States, which is really the backbone, in my opinion, of the American economy. All right, so it's progressive. Accountants don't lose their jobs. I know some of you might be going, oh, what about the poor accountants? We need to help them out. Trust me, there's still a need for accounting. Because if you are a small business, you need to prepare you need to still keep books if you want to go get a loan from a bank. So if you want to, or get outside investors for your company, you're still going to need to keep the books. So there's still a need for accountants. Don't worry about them. We're just going to keep them on doing things that are much more productive for American society as opposed to the somewhat unproductive thing of looking for loopholes. All right, our products compete globally. These are all potential subtopics for your paper. All right, so here's where you need to go. Not Ottawa.edu. Fairtax.org. Okay, here's the website. And if you guys click on how the fair tax works, this is some of the information I went over with you today. You are not supposed to do your paper on what we went over today. Okay? So that's you can kind of summarize some of it. But what I really want you to do is to drill down into something like Sawyer brought up on inequality, or if you care about small business burdens and the number of hours being worked or whatever. So get into something detailed. At this lower left-hand corner, it says need more info, view our research. And here are some great subtopics. Agriculture and ranching, industry, real estate and home ownership, testimony, fair tax in the economy, taxes, finances, demographics, charitable giving, business. You know, one of these things, if you drill down into this, you will find a number of different specialized articles. How does the fair tax in the global economy? Let me just click on this one just to show you. There's a PDF that is what they call a white paper that will be about 3 to 4 pages long, and it's going to explain in detail whatever issue you happen to be interested in. If it's home ownership, if it's inequality, whatever. Right? So you're going to have to dig around the website and find something that you're interested in, and then that's what your subtopic is all about. Is kind of drilling down a little bit deeper. There's lots of little interesting things going on with it. And then in the email, I also just cut and pasted from the syllabus. You're to do a 60-second video as part of this project. I don't care what you use it on, with a phone or some sort of device. You guys figure that out. I know you're smart enough to figure out how to run videos nowadays. And you're going to give a little elevator pitch about your subtopic, about what it is and why it's important, and this is how it affects it, but only 60 seconds. By the way, I had it 30 seconds last semester, and it was too short. So you will easily fill up 60 seconds. So 60-second pitch. That's all you got to do.
It's just talking about why we feel like our subtopic is important.
Not only why, but also some of the results that you found about it. Yep. You can send it via email, or get it to me on a thumb drive or something like that. Whatever works.
What's actually supposed to be?
I should maybe have everybody post it to YouTube.
I never understood
Rich,